The Monetary Policy Committee of Nigeria's Central Bank has kept the interest rate at 11.5%. Other key policy parameters were also left unchanged. Chinaemerem Joseph reports.
For the fourth time in a row, the Central Bank of Nigeria has left the interest rate unchanged. It was last reduced from 12.5% to 11.5% in September. That decision was made to encourage growth in the country, but progress has been slow.
With inflation at a 3-year high, this being the bank's core mandate of price stability, a contractionary policy stance may be required to tame the rising trend. It therefore feels that a hold position, which encourages management to continue to use its various intervention mechanisms to deploy liquidity into employment generation and output stimulating sectors of the economy, will be desirable, as this would help consolidate the country's recovery process.
Poor GDP, high inflation and unemployment rates have slowed growth, but the bank's Monetary Policy Committee is still projecting a positive outlook.
Given that we're just crawling out of recession, there's a need for us to continue to do those things that we did, and more intensely, those things that we did that took us out of recession, looking at supporting interventions, particularly in the agricultural sector, in the manufacturing sector, in the ICT sector, in the services sector that where we had double-digit growth, in the creative industry sector, in all those other sectors that helped us to exit the recession.
The CBN didn't make any changes to the exchange rate policy, and it didn't devalue the naira, despite some speculation that it would.
Nigeria has not changed from its foreign exchange management policies. Nigeria still remains on a managed float. What does the managed float regime mean? That the central bank, being the institution that has a core mandate for foreign exchange management in the country, would run the market, see to how the market operates, depending on its reading about how exchange rate moves in the market, will come from time to time to intervene in the foreign exchange market.
The committee says it's concerned about the rising rate of inflation. The problem comes from the increase in the cost of food because of insecurity in states that produce the country's food. The bank is increasing its support to try and boost the agricultural sector, but it wants the government to address the security issues, allowing costs to fall. Chinaemerem Joseph, Arise News.